Going long is the most intuitive move in trading. You buy an asset, whether it's a stock, a currency, or a commodity, because you believe its price will increase over time. The core logic is simple: buy low, sell high. Your profit is the difference between the purchase price and the higher selling price, minus any fees. This is the default position for most new traders, as it aligns with the general upward trend of markets over the long term. However, markets do not always go up. When a stock or index is falling in value, a long position leads to losses. This is where the concept of going short becomes powerful. Shorting is the act of selling an asset you do not own, with the intention of buying it back later at a lower price. To execute this, you borrow shares from a broker, sell them at the current high price, and later repurchase them at a lower price to return to the lender. Your profit is the difference between the high sell price and the low buy price. The mechanics of a short position can feel counterintuitive. Instead of buying first, you sell first. You are betting against the asset, profiting from its decline. If you short a stock at $100 and it drops to $80, you make $20 per share. This opens up opportunities in bear markets, crashes, or simply during a company's bad earnings report. It allows you to make money regardless of the market's direction. Understanding the risks is crucial. In a long position, your potential loss is limited to the amount you invested, because the price can only go to zero. In a short position, your potential loss is theoretically unlimited. If the price of the asset rises instead of falling, you are forced to buy it back at a higher price. Since a stock can rise to hundreds or thousands of dollars, your loss can exceed your initial capital many times over. This is why shorting requires strict risk management. Another key difference is the concept of margin. When going long, you can often buy with cash you have. When going short, you must have a margin account and maintain a minimum amount of equity. If the price moves against you, the broker may issue a margin call, requiring you to deposit more money or close the position at a loss. Short squeezes, where rapid price increases force many short sellers to buy back shares, can amplify these losses dramatically. Despite the high risk, mastering short positions gives you a significant advantage. You are no longer a passive participant who must wait for the market to go up. You can profit from volatility and downward trends. For example, during economic recessions or when a specific sector is overvalued, shorting allows you to hedge your portfolio or generate positive returns. It transforms you from a one-directional trader into a flexible strategist. Professionals rarely rely on a single direction. They combine long and short positions to create market-neutral strategies. For instance, they might go long on a strong company in a weak sector while shorting a competitor. This way, the overall market movement cancels out, and they profit from the relative performance between the two assets. This is how many hedge funds generate consistent returns regardless of whether the market is up or down. To profit in both directions, you need to study technical and fundamental analysis for both trends and reversals. You need to identify not just when to buy, but when to sell short. The emotional discipline is different too. Going long feels optimistic, going short feels contrarian. But by mastering both, you stop being a gambler on direction and become a true trader. You learn to treat every price movement as an opportunity, not a threat.